Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Sam Reynolds, Managing Director of Octopus Investments Australia. Sam, welcome.
Hi Alex, how are you?
Very well. In terms of your background being a renewable energy specialist, oil and gas, they've taken a big hit due to coronavirus. The prices have come down. Curious to get maybe your thinking around sort of what the future holds for these oil and gas companies, particularly as they now compete against renewables, and how that value trade looks.
So, yeah, as you say, look, coronavirus has had a big hit on oil demand. I think it's down probably a third due to travel bans. And we've seen actually in the US where oil dropped below zero for the first time ever. And really landing a direct hit on a sector in the grip of its own crisis and change. And that is how to evolve when climate change has risen up the agenda, both politically, but also in the hearts and minds of consumers, and more importantly to some of the big oil majors' shareholders. And so it's worth maybe talking in terms of the investor response, but then also just looking at some of the how capital and how these businesses are starting to transition to a sort of a low carbon future. And in regard to the investor response, and we've seen it here in Australia, but it's probably a bit more prevalent in Europe and the US. So investors and shareholders around the world are pushing corporate management teams towards incorporating climate change into their business plans and strategies. And you would have seen HESTA, the industry super fund, just last week. I think they came out and said that they're reducing carbon emissions in its investment portfolio by over 30% by 2030, and to be net zero by 2050. And we're seeing a lot more of this come from shareholders and shareholder members as they're running their own internal studies. This is being more and more prevalent. This is high on the agenda. And then if you look at the other side, where's new investment coming? And we're looking at the first time in history that actually CapEx in renewable energy will overtake upstream oil and gas supply in 2021. So the first time ever that more money will be spent on renewables than oil and gas. And what that also means is for future supply. So you're probably sort of seeing things around when is oil demand going to peak? That was around sort of 20 years from now. Those studies have brought that into 10 to 15 years from now. And if you're looking at investment into the sector, so if you're looking at hurdle rate returns for investors into oil and gas, because they're pricing in a carbon price and an environmental price, and investment returns are looking at sort of 15 to 20% for upstream oil and gas investment, while our assets in Europe, regulated assets, so some with government support, they're trading at around 5% at the moment. So there's a real difference in the cost of capital to the two energy sectors. And one of the big things, I suppose, at the moment is how the big oil and gas, the global oil and gas companies are transitioning to a low carbon future. And what we've seen more recently is a lot more being spent. So budgets have gone up sort of threefold, I think, in the last 12 months, how much they're spending in regard to accelerating their presence in the low carbon space. And that's into renewables, into PPAs, so signing PPAs, but also capital investment into renewables, also electric vehicle infrastructure. So these businesses are starting to make the transition, and also coming out very publicly to say, so BP, Shell, Total have all come out publicly to say that they're looking towards net zero by 2050. So a very interesting time for the oil and gas majors.
It's interesting you say that, in terms of the amount of capex that's going into renewables and obviously a lot more supply coming on board. What happens to maybe some of these oil and gas companies, some of them that are pretty old school? Yes, there are some that are moving, but the ability for them to maybe keep lowering prices as they try to maybe deal with some geopolitical issues and push the oil price down. I'm sort of thinking maybe it's more of a capital markets question, but just sort of that relative cost for production of energy. How do you think about that potential risk? Particularly, obviously, you mentioned that oil prices went below zero. It was more of a futures problem and a mismatch in demand and supply. But how do you think about that in terms of the relative value of renewables in this sort of current environment?
Yeah, definitely. I think the issue that they're going to have is that quite a lot of laden with debt at the moment. So they're going to need some sort of support, as you say, capital market support to continue trading. And whether some governments, Canada's come out to say that they're going to support some of the oil and gas majors through their debt concerns because they want to keep them up and running. And in regard to supply, so the key thing is that they're going to have a sort of a bigger geopolitical and consumer impact on those majors and economies reliant fully on oil and gas. And what we're seeing at the moment is you look at the man and woman on the street is not as concerned with the air that we breathe as a population. And that is mostly due to, if you look, there's less cars on the roads, there's less planes in the air. And this is something that they want to see as the norm going forward. So there is going to be that sort of added pressure, even though oil prices might be low now, and China is probably filling up its reserves at the moment. But there is going to be pressure on economies around the world to reduce their use and reliance on oil in their markets.
Mm-hmm. So, let's maybe take it closer to home. When the Australian government sort of changed its view on renewable energy policy of late, and there was some discussion about sort of the role of renewable energy as part of nation building. Can you give a bit more context in terms of what does that look like, or what have you heard there?
So, yeah, our recent conversations with government and mostly state government is that renewables projects are being viewed as priority infrastructure, and that the Australian government is seeing renewables as a way to help jobs in the market, and especially rural jobs. So renewable energy assets can get up and running relatively quickly. We can have sort of assets up and running into construction in 3 to 6 months once we've done our initial DD and it's gone through planning and grid, etc. So they're talking to us about, look, how can we get these projects into construction to start getting workers back into the market, but it has to be done under a sound regulatory framework. Now, renewable energy doesn't need a government subsidy to be viable, but the government doesn't really need to support renewables, just doesn't need to inhibit the progress of renewables. And the governments are seeing more and more that actually renewables are being really positive in the market as a way to get the economy back on its feet.
Mm-hmm. It's interesting you mentioned sort of the rural areas as being a really key part of it. And I know a couple of the questions that we get at our events around sort of how to, where these types of projects best suited. Are these renewable projects still best suited to maybe these rural areas where they need very large areas of space, and there's particular maybe applications, where the power will feed into? How do you think about sort of the optimal place maybe for renewables to fit in?
Yeah, so the bit different to where we've built most of our assets in Europe. When you're looking at the three elements of developing a renewable energy site, so you look at grid, planning, and land. So when we built in Europe, grid is the easiest one of those three. Land and planning are more challenging because of the concentrated nature of the population and smaller countries. whether it be built in the UK, France, Italy, the Nordic region. In Australia, land and planning are relatively straightforward, but grid is the number one factor, and that's where we spend a lot of time on our due diligence. And most of the projects that we take through our internal DD filter, we throw them out because of grid. So you've got to have a look at the big pipes that transport electricity around the network, and you want to be on the stronger pipes in the network that are going to remain up and running. Now, it doesn't mean you can't build on skinnier parts of the grid, if you like, but you have to factor in things like loss factors and line loss factors into your models, or potentially curtailment, where there's just not enough line capacity for all the energy to be transported down it, and which means you could be constrained. And that's so grid in Australia is number one. So location on the grid is where we generally start. Then you start to look at planning and land. And when we do start to look at planning and land, we also spend a lot of time with the community. And that's really important, that you make sure the community engagement starts a good 12, 18 months before you start construction, and put in place things like hiring as many construction workers from the local community as you can. What other things can the solar asset bring to the community? We're looking at scholarship programs to send kids off to university from the local area. Things like solar street lighting for the local town. Other things around providing high-speed Wi-Fi, because we've got to do this anyway into our site to communicate it with our site. Can we provide high-speed Wi-Fi to the local town? So we want to make sure our sites, which are going to be there for 35 years or longer, have a really positive impact, because, as you say, most of the renewable energy that's going to be built in Australia, the 200 billion that is thrown around of new investment, is going to be built in rural areas, and therefore we need to make it a really positive impact. And that's why the community and environmental engagement is really important.
It's interesting that you talk about the rural backdrop. Is that because it's an easier sort of containment to build these large farms, and they feed in directly to the local community, and that's the grid part that you're talking about? That it's an easier link, and there's not the sort of the heavy load on power that is one of the big questions and one of the big concerns about renewable, that it can't provide this power for really high energy intense style industries.
So no, really why they're built in the rural areas is mostly because access to land. So large-scale solar and wind need access to land, and you need planning approval. So you can't be putting, as you can imagine, large wind farms right next to towns. They need the land access, but they also need access to the big transmission lines for transporting electricity around the grid, which link up the states as well, especially within the national energy market, which is the eastern seaboard of Australia. So the real number one reason is access to the grid. Now, renewables can supply into all parts of the grid. That's what they do. They link into the grid, same as coal-fired power stations or gas, but they need, as you can imagine, because solar comes off at night, they need what you call is firming. So they need things like gas or storage to make them available for baseload. So baseload just means that the electricity is constant, and you can use it as and when required. And that's why renewables is required alongside other forms of generation. It could be coal, could be gas, could be storage or hydro in Australia.
Mm-hmm. You talked about sort of the storage piece there. Obviously, it's got a lot of notoriety of late in terms of the new battery technology that's coming out. Can you give a bit more context in terms of what's happening in that space, and is there enough batteries out there to really make a sizable change, or does each individual house still need to have its own battery maybe to sort of charge up? How do you think about that piece?
Yeah, so our next two assets will have storage on them, but all of our assets will be storage ready. So And we're looking at the economics of storage closely. We have been for a number of years. The economics are just starting to stack up. They will come down further as more batteries are integrated into the market, and you can really understand and start to monetize the different revenue streams you can get from having a large-scale battery. So it's not just the arbitrage of selling electricity, of storing electricity in it during times of low cost and selling the electricity back to the grid during high cost. There's also you can also have services available to the grid operators around on demand of that electricity that can be used instantaneously to help the grid operators manage the grid. Also things like balancing the grid when renewables are coming off and on. So those things are still being done, but a little bit like solar panels. So solar panel technology costs came off about 65% in the last 6 years. And that's because they became more mainstream, and China and large-scale production facilities were created around solar panel technology. And that's exactly the same thing will happen with storage, making them more viable to be putting into the grid and across the market.
So the natural question then, I guess, when you talk about sort of such a large drop in price as being 65% on sort of the solar panels, and you're expecting sort of similar changes, hopefully, in the economics of storage as well. As an investor, as you look at this particular part of the market, how do you sort of factor that part in when these are long-term projects, and then you sort of think, okay, hold on, in 3 or 4 years or 5 years' time, there'll be another 50% drop in prices. How do you sort of try to frame that part of the investment decision?
Yeah, definitely. So solar panels make up about 35% of your capex on a renewable energy site, especially for a solar site. So if you're looking at the other factors, transport, labour costs in Australia are quite high. They're also going up. So they start to counter any reductions in technology, and solar panels also got down to a level where they're very much commoditized. So they're being the best producing panels are produced around the world now, not just by the Chinese, but they're produced in other markets. So it's flattened out a little bit, but you also price new technology and next generation technology into your long-term energy curve. So even though in Australia we've got our coal-fired power stations, the majority of our coal-fired power stations are coming off in the next 10 to 15 years. It doesn't mean the energy price is going to skyrocket. It could if those coal-fired power stations come off in an unorderly manner without forecasts. But the things that bring the energy price down is the next generation of renewables and together with storage. So that's why when we look at our models, we run a relatively flat energy curve, and that's one of the key assumptions in the long-term model of a renewable energy asset is your long-term energy curve. But it should factor in new technologies, costs coming down, competing technologies, all that sort of thing goes into sort of how that curve is shaped.
Mm-hmm. You mentioned there about sort of the new technologies that are coming out. They're obviously wind and tidal are some other renewable energies that are also out there. How do you think about them? Are they also part of the consideration as another option for you?
Yeah, definitely. Yeah, we do wind and solar, and so tidal. We haven't done any tidal. So tidal for us is probably a little bit more nascent. So the technology is probably not where we would see at a full commercial scale. And look, solar and wind have taken probably 30 years to get to the stage where they are now, where they're at what we call grid parity, where you can compare them now to existing generation of coal, gas. So with things like tidal, the next generation, it's not just the quality and the efficiency of the technology. It needs also the services and the production to be built around it. So those that can service the technology and those industries, supporting industries, still need to be built in order to make it on the same level as solar and wind and get to grid parity. and so that'll come in the future. And then you'll need large amounts of capital. So the capital will need to come into it and access it. So big insurance and pension companies will need to come into it, get the cost of capital on something like Tidal down, and then it becomes a mainstream generation. But next stage generation technologies are not there yet, and they can take decades before they can be commercialized at scale.
Mm-hmm. You mentioned capital there, and you sort of just touched on it about in terms of service and people. So the human capital piece of the puzzle, what does that look like? In terms of the solar, a solar farm, for example, where is the human capital sort of most deployed?
Yes, so quite a bit up during construction. We've got 500 workers working on our first solar site in southern New South Wales, and then after that you have an O&M, an operations and maintenance team, and then an asset management team that keeps the operations going after you've finished construction, and then things like revenue management. So just on one of our sites, about 60-70% of the asset will have a long-term power purchase agreement, so that'll be a fixed element of the revenues. But you'll also have 30 to 40% of merchant. And when I talk about revenue management, you need to constantly look at these assets and see, is that level of contracting right? Do we want to have a longer term contract? Do we want to maybe have the asset at 100% PPA rather than have a merchant element? It really depends on where we're seeing the market in the future. So that's another there's another team that will also look at that side alongside the general asset management of the project.
Mm-hmm. Interesting you mentioned the PPA and sort of that whole accounting and financial analysis piece. Obviously, we're going through COVID-19, still having a large impact. Credit quality is an issue. How do you look at that, and how do you think about sort of the credit quality of where you're supplying ultimately as part of these PPAs that you're drawn up?
Yeah, good question. So PPA credit quality is a bit of a case by case depending on the specific counterparty, but the benchmarks we have are fairly encouraging. The majority of PPAs in Australia have been signed by energy retailers. That probably makes up about 60%. And then the balance is government, so government entities, and then also you're getting a number of investment grade counterparts. So large corporates, global corporates are coming into the market, and some big consumer brands you would have seen more recently, and mostly along the lines is you don't want to be the only big consumer brand, whether you're an online technology business, a data center, a supermarket, and you're not getting your energy from a renewable source. You don't want all your competitors to be advertising on that front while you're sitting getting your energy from a coal-fired power station, etc. So there is a real impetus for these large consumer brands to be signing up PPAs, and there is a bit more activity on that space more recently post the bushfires also.
Is there more work that you're doing? You mentioned in retail, but is there also work that you guys do in terms of trying to get people like households to sort of sign up for these sort of, making sure that their power does come from renewables in these local bush areas and rural areas that you mentioned?
So we are looking at some products where we can supply our energy from our sites cheaper to the local community. So having a slightly different tariff. We're working on a couple of things on that front. And we have some technology with our Octopus energy business that can trace electrons from source through the grid to the end user. So I think that's going to be a bit more exciting definitely for corporates, but also for local communities and how they're getting in their energy. And then one step further would be to trace it back to, say, a super fund member. If a super fund is investing into a particular asset, you can sort of illustrate how the energy from the asset that they've invested into, where that has ended up. And because you want to showcase these assets to investors and to consumers that, look, yes, they're providing clean energy, but they're also doing some great things for the community and in the rural areas. And so there's those economic benefits as well that should be showcased as part of the investment thesis.
Mm-hmm. So the next question is sort of you talk a lot about ESG, but we talk also about sort of the sustainable development goals and the need to sort of understand the supply chain. How do you also sort of make sure that the solar panels also sort of tick that box around that full supply chain, understanding that the whole supply chain is sustainable as well?
Yes, yeah, no, it's a good question. And look, we also sign up to the UN SDGs, and what we've looked to do initially today is we're focusing on 8 primary SDGs, and then we have 11 secondary SDGs. And going back through our supply chain, it's not something we've done. We do go to the factories to look at where our solar panels come from, etc. But we haven't gone one step further to see actually how are the minerals and how are the other resources brought together to make our solar panels, and that will be a journey that we'll be under. Also, how solar panels at the end of their life, at the end of a 35-year life, how they get recycled. And those industries still to be developed. There is some parties recycling solar panels, but they will be industries that will be developed and that will start to support as well. And just things like, as you know, with sort of getting cars or other compliances recycled hasn't been great in the past, but it's definitely things that we'll look at as we go on this journey with the SDGs.
Mm-hmm. So maybe final question, as we think about it, we started off and you talked a little bit about sort of the government, not having to provide the same sort of incentives that they did previously around renewables. What else are maybe the other informational barriers that investors, as they think about renewables, need to sort of maybe think about a little bit more in terms of getting them comfortable about this as really as a truly infrastructure investment opportunity that does have its ESG lens as well that can be directly put on top of it?
Yeah, definitely. So a couple of things. I mean, and there's no better environment to see how renewable energy assets have fared than the current environment under a corona cloud. And look, the impact on the revenues has been felt on, if you like, as I mentioned, most of our assets have 60 to 70% long-term power purchase agreements. So they're fixed. And so the impact currently being felt on our assets is on the 30 to 40%, which is merchant. But really, we're only seeing about a 5% drop in demand in electricity. And that's because, look, just because people have moved from working in offices to working from home, it doesn't mean they've stopped using electricity. So what we see at the moment is what you'd get in electricity, a weekend demand, we're now seeing as a 7-day week demand, if you like. And so even if this continues for, say, 3 years, as it only impacts that 30 to 40% element of your revenues in these 2 to 3 years, it doesn't have a big impact on your overall returns for a 35-year asset. And that's where renewables is stacking up quite well, and we're getting more and more interest in the asset class, especially from those who've invested in traditional infrastructure around airports and toll roads. And the other part of it is also that the fuel source. That means wind and sunlight. So obviously sunlight and wind volumes are not market linked, and no surprise there. But probably the other misconception in the market is that wind and solar resource is unpredictable. That's not true. We have now bankable standards as to how to predict wind and solar volumes. And this comes from having decades of weather data in particular areas of where you're going to build your assets. And these inputs are free to use. So as I mentioned, not market correlated. And that's why it makes this asset class a very strong, defensible asset class during these times. The other only key aspect is the operations and maintenance. There's a very low operating costs on renewable energy assets, and so they do continue to provide good liquidity to service equity and debt, and that's a key aspect for these assets, and why we see them as long as they've done right with an experienced management team up front, we see them as long-term, relatively boring defensible asset plays and should be part of any infrastructure portfolio going forward.
All right, that's been a fantastic conversation. Thank you very much for your time today, Sam.
Great. Thanks for your time also, Alex.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Conexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.